going on, everybody? This is Cuervo from Stack Trading, and today we're going to dive into what separates long-term winners from gamblers in the markets, and that is risk management. I've seen a lot of videos lately coming out saying, trading is gambling, blah, 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 or it's people commenting on traders' content saying, you're just a gambler, you're just getting lucky, this or that. So we're going to dive into that. Like, is trading really gambling, and is there a way that you can do this without feeling like you're going to the casino every day? The simple answer is if you don't want your trading to be gambling, then you need to have a rock solid foundation and understanding of risk management. So forget obsessing over chart patterns for right now. If you're just starting out, the most important thing you can understand is risk management. If your risk management sucks, no matter how good your entries are, no matter how much you chart, you are going to bleed out over the long term. It's just a matter of probability and statistics, and we'll get into that. So that's a pretty big claim. Why is risk management more important than learning chart patterns when you're starting out? The reason for that is chart patterns for sure are going to help you with your entries. There's no doubt about that. But a good entry doesn't protect your capital, and that is the name of the game. Protecting your capital and hopefully having a positive equity curve, because that is the whole point. You are here to make money. You're not here for dopamine. You're not here for euphoria. You're not here to have a good time. You are here to make money. That is the one and only goal, and this is a zero-sum game. If you are making money, someone else is losing money. So a trader with average entries and tight risk management is going to beat out a chart god who over-leverages and refuses to take a loss and adjusts his stop loss, etc. Like I said, this is a numbers game, and it is a zero-sum game. Every single edge that you can define and utilize is going to exponentially improve your trading. Having set losses on every trade is huge, absolutely huge. This game is about staying in the game long enough for your edge to work. If you're just yeeting trades with no set risk, you're going to get washed out like that. Most traders that become funded lose their funded account within a week. The smaller majority is maybe making it 21 days total before they blow up their account. And I believe that is strictly because of risk management. Not because they don't know how to chart, not because they don't know what they're looking for, but because they aren't defining their risk and they're not sticking to specific risk parameters. So when I say trading isn't gambling, that's not entirely true. Every single trade you put on is a bet, not a guarantee. Even your best bet is going to fail sometimes. That's why managing losses is more important than maximizing wins. Your edge isn't about being right, it's about letting math and probability work in your favor. So now that we've got that out of the way, we understand that trading is a game of probabilities if you have good risk management, but you are taking a bet every time you place a trade. Well, hopefully your edge provides you with a high win rate so it doesn't feel like you're gambling, but really at the end of the day, what you are doing is putting chips on the table and saying, if I'm right, I'm going to take more chips off the table than I put on, and if I'm wrong, I'm going to lose these chips. So what is risk to reward? Sometimes you'll see risk reward broken down as R/R. That just means the ratio of how much you're risking versus how much you are hoping to make at a level that you're targeting price action to move to. If you risk $100 to make $300, that is a 1-to-3 risk reward. The higher your reward compared to your risk, the lower your win rate needs to be to stay profitable. And that is huge. Me personally, I have about a 70 to 80% win rate. That fluctuates, and you don't need to attach your ego to your win rate. As long as your risk reward ratio and your win rate are at the right levels, meaning your win rate is higher than the win rate you need to be profitable for your risk reward, it's all gravy. It doesn't really matter until that changes. So that's something that I really want to highlight. I really, really want to highlight. The higher your reward compared to your risk, the lower your win rate has to be. 1 to 3 is my favorite win reward because I'm generally risking about $1,000 to make 3,000. Now, I trade in queue mostly, so I'm really risking 800, not 1,000 on the dot. That's just because my stop losses are 20 points and my TPs are 60 points. So that meaning I'm trading two minis usually. I'm risking $800 and I'm looking to make about $2,400, give or take, slippage or having to close the position early because it doesn't hit TP. So that's a bold claim saying that if you have a good risk reward, you don't even have to have a good win rate. So let's really look at the numbers. For a 1-to-1, which is, I do not recommend trading a 1-to-1 risk reward strategy. You're going to need a 50% win rate. Now, that's still not that high, but over the long term, it's not ideal. A 1-to-2, you only need a 33% win rate. That means you can lose 2 trades, and if you're profitable in the next trade, you're break even. So on the third trade, if you hit TP, those 2 losses are null and void. They're not an issue anymore. Now we're getting into the gravy, the real sauce. 1-to-3, what I really strive to look for in my setups, especially in my larger accounts. When I start helping some of y'all navigate prop firms, especially some of you that have more capital, specifically $150,000 or higher, what I'm really going to suggest is you take maybe 5 trades a week and you are only looking for 1-to-3 risk reward. So you only need to win 25% of those trades. In 4 to 5 trades a week, you only have to win 1 trade if you're taking 4 a week with a 1-to-3 risk reward to break even. Now that's not ideal. We're here to make money. So with 2 wins, with a 1-to-3 risk reward, you are going to be profiting. If you are, let's just say for the sake of argument, you're like me, you're trading in queue. Let's say you lose 2 trades. Start the week, you get clapped. You're down $1,600. Step away from the charts, come back another day when you have the right setup, and you smack a win, you're now break even. Step away. Let that euphoria settle. You do not want to be trading when you're all jacked up on a fat win. It's not ideal. You're going to get cocky and start flinging trades, and then you're going to nuke your account. So step away. You come back for that 4th trade, and you hit another 1-to-3 risk reward. You are now up $2,400 on the week. Need I say more? Now, where it gets really crazy, 1-to-5. Those aren't as common, but if you can find those setups, take it. A 1-to-5 risk reward is incredible, and you only have to be right less than 20% of the time to be profitable. Now, that's under the assumption that you're always taking 1-to-5 risk rewards. So these win rate percentages are only accurate if your risk reward is static and defined, and you're not changing it. When you start changing your risk reward, it starts affecting what your win rate has to be for you to be and stay profitable. So that's why it's important, because I don't know about you. I've said it in my introduction. I dropped out of college. Not a big fan of doing math on the fly in my head. So I like to know I'm looking for 1-to-3 risk reward ratios, and I just need to win 25% of my trades to be profitable on the week. So that is why this is huge. But the smaller your win rate, the bigger your rewards need to be. So keep that in mind. If you're trading a 1-to-1 and you only have a 10%, 20%, 30% win rate, you're getting clapped. So you need to adjust, and you need to look for 1-to-3. Maybe even 1-to-5 as you work on getting that win rate up. Keep at it, Tiger. So we've talked about what makes a profitable trader. Now let's really dive in and break down how losing traders think, because this is a game of psychology. It's more important than anything else. If your psychology's off, everything is off. Losing traders are obsessed with being right. I do not care if I'm right. I don't care if I get stopped out, because I know that if I'm right the next time, it's going to more than make up for it. That is how you keep your psychology in check. I don't care if I'm right. My ego doesn't matter. My ego does not have any factor into my P&L, and whether I'm right or wrong is completely irrelevant. Losing traders are going to double down on losers. They're going to see that they're about to hit stop loss or they're in drawdown, and they're going to freak out. They're going to say, can't do this. I need my account to be at this level, XYZ, and they're going to add to their losers, hoping to average down and eventually crawl out of that hole. Especially in prop firms when you're getting liquidated at, it depends on where you are, but me personally, Eastern time, I get liquidated every day at 5 p.m. It doesn't matter if I'm up $10 million and I am targeting a $25 million take profit. It doesn't matter. My firm doesn't give a shit. They are liquidating my ass. That's why it's also huge to have defined stop losses in these prop firms, because the rules are a lot tighter. You can't just swing a position that was supposed to be an hour-long trade or a 10-minute trade and be like, well, I'm in a ton of drawdown now, so I'm just going to swing this thing because stonks only go up. Losing traders are doubling down on losers. Do not do that. If anything, add to winners. I don't recommend starting out adding to winners. That's something I do as my psychology needs to be adjusted, and I need to reinforce that I'm profitable and that when I'm winning a trade, it's because my analysis was correct and my entry was on point. So that's why I add to winners sometimes. I don't recommend that starting out. It's the opposite of what losing traders do. Losing traders are cutting their winners too early. When you're cutting your winner, you're affecting your RR. Yeah, it's a winning trade, but you still risked $800 to maybe make $600. That's a negative risk reward. If you get in the habit of cutting winners early, you are affecting your statistical probabilities and outcomes. Now, the worst thing you can possibly do is when you get in this idea of I have to be right, you might just abandon stop losses altogether. That is the worst thing you can do. You have to have a stop loss. If you don't have a stop loss, you are just asking to get wrecked. You are going to get wrecked. It's going to happen. Either you're going to be in a position with no stop loss and Trump's going to come out and say, I'm headed over to Jeffrey Epstein's house. Me and the boys are going to, have a baby oil party. And then the market tanks 100 points because Trump's on the way to a Diddy party and we're all like, excuse me? If you had a stop, even with a stop loss, if there's a huge move in the market, there's something called slippage where there might be so much space between the bid and ask, you might not get filled until like 20, 30 points below your stop loss. That's called slippage. So even with the stop loss, you're not always totally protected from these events. That's why news is important too. You don't want to be trading in any high volatility instances because it's just not worth it. So without a stop loss, it's inevitable that you're going to get wrecked. I am a profitable trader. I'm funded through multiple prop firms, and I've been doing this for 8 years, and I'm still wrong, 30 to 40% of the time. If I was trading without a stop loss, one of those trades in that 40% is going to absolutely nuke my account, and I cannot let that happen. My job is first and foremost to protect the capital that I am trading. Your first most is to protect your capital. Without protecting your capital, you will not make money. We've talked about how losers think. Now let's talk about how the winners think. You're here to learn to think like a winner. Funded, profitable traders literally just do the opposite of everything that we just talked about. They define their risk before the trade. You're not in the trade trying to figure out where your stop loss is going to be and where your take profit is. You know that before you enter the trade. You stay consistent in your position size. If you lose, you're not levering to the tits because you're trying to make back a certain amount of dollars. You are going to be patient, calm, and allow the math to work out. It doesn't matter that you were wrong last time. Over the long term, if you have a profitable strategy, it does not matter. Just allow time and math to do the work. Trading is a business. Losses are just a business expense. It's not a personal attack. It's not an insult to your intelligence. The market is chaos. The market is a beast. To think that you are going to be right all the time is absolutely foolish and chocked full of ego and hubris. You're going to get smoked if that's your mindset. Profitable traders have no emotional attachment to whether they're right or wrong because they know the probability is going to work in their favor. It's not about the single trade. It's about the long-term statistics. So with that being said, let's talk about the power of small losses. You can be wrong 70% of the time and still make money if you keep your losses small and protect your capital. If your winners are 3 to 4 times bigger than your losers, that is the magic of asymmetric risk. I've had some incredible mentors in my time in this industry, and one of my mentors, he goes by Sage, shout out Sage, talks about asymmetric risk all the time. And I never get sick of hearing about it because Sage has made a fuckload of money because he understands asymmetric risk and he has an intimate understanding of risk reward. If you keep your risk at 1% or less per trade, your capital and your confidence stays intact. And that is what has to happen. When you are in the business of protecting capital, you cannot be scared. You have to understand that you have a system in place that over the long term is going to work out. That's how you keep your psychology in check. So let's talk about using these risk controls on a daily basis. Here's what I use and what I recommend in stack trading. 1 R per trade, fixed dollar risk. So 1 R per trade, you have fixed risk. 2 R max daily loss. So if you're risking $100 and you lose 2 trades in a row, cut it for the day. It happens. You're not going to have a green day every single day. Use hard stops. No hope, no prayers. I'm a man of God. Am I degenerate? Yes, but I am a man of God, and I'll just go ahead and tell you, I'm not saying any prayers during the trading session because I know no one's coming to help me. I signed up to be in this market, and I know that hopes and prayers are the pathway to blown accounts. I'm not asking God to save me in any of my trades. Why? Because my risk is defined, and I know what my win rate is, so I'm not worried about a stop out. I cannot emphasize enough how freeing that is for your psychology to know that it doesn't matter if you lose. It's just a business expense. So you use hard stops. No hope, no prayers. Sorry, God. Journal every single loss. There is always a lesson. And what I've been experiencing in these current market conditions as we've been trading very low volatility, not a whole lot of volume, not a whole lot of market maker participation, is I'm entering trades with the right bias and the right thesis, but my timing is just a little bit off. I'm not waiting for any kind of accumulation, manipulation, distribution. I might enter during the accumulation period and then get stopped out during the manipulation. What you want to do is break that trade down on the chart, be like, okay, look, here's the accumulation. I was thinking that we were going to hold support. I set my stop below the range that we were accumulating in, and then the manipulation wave came in and stopped me out before the distribution. If you are reviewing that, you're going to learn from it and stop making the same mistake. And that's only going to improve your win rate. And if your win rate was already 60% and you're trading a 1 to 3 RR strategy, that extra 10% is going to equate to thousands of dollars in your pocket. So here's the truth, and here's the final words. Risk management is not optional in this industry and in this game. It might be optional for people who are here to just F around and throw some money at a chart, but it is not optional for people that want to do this professionally. It's not a strategy. It's how you manage the math behind it that creates long-term profits. You don't need to win every trade. You just need to survive and execute with discipline. If you still have questions, join us in Stack Trading. If you're ready to master risk and not just chase wins, we're there all the time. We've got a great community in there. We've got some incredible traders. So I hope to see you there. The link is in my bio in the description. If you found value in this, like, comment, subscribe, and I'll see you in the next one.